The notification appears on your phone at 6:47 on a Thursday morning before your alarm goes off. It is not from your bank. It is not from your mortgage broker. It is a Canada Post tracking notification informing you that a registered item requiring your signature will be delivered to your address today between 9 and 5. You have not ordered anything. You are not expecting a package. Your stomach tightens in a way you cannot immediately explain. You lie in bed staring at the ceiling for 11 minutes before you get up. Something about a registered government envelope arriving on a Thursday morning feels wrong in a way that bypasses logic and goes straight to instinct. The carrier arrives at 2:15 in the afternoon. You sign for the envelope, you bring it inside, and stand in the front hallway still wearing your coat. The return address reads Canada Revenue Agency, Appeals Division. The transaction inside this envelope is one you closed more than 2.5 years ago. You sold a house, you made a significant profit, you claimed the principal residence exemption, you filed the return, you received a notice of assessment confirming it was accepted, you moved on, you bought another home, you spent the equity, you considered that chapter permanently finished. The Canada Revenue Agency is writing to inform you it is not finished. The document inside is a notice of reassessment for your 2022 tax year. The agency has reviewed your file. It has determined that the principal residence exemption you claimed on the sale of your home has been denied. The revised amount owing, including taxes, penalties, and compound interest calculated daily from the original filing date, is printed at the bottom of the page in a font that seems larger than it should be. You read it twice. You sit down on the stairs still in your coat. You think about the deposit you used for your new home. You think about where that money is now. You think about the fact that you do not have the number printed at the bottom of that page anywhere in your possession. Welcome back to Canada Property Watch. In our previous investigation, we exposed the exit tax, the mechanism the CRA uses to deny the principal residence exemption on current and recent home sales by attacking the technical requirements that most Canadians never knew existed. That video generated thousands of responses. When the single most urgent question that kept appearing in your comments was a version of the same fear. What about the sale I already completed? What about the transaction from 2021 or 2022 when the market was at its absolute peak, when I made $200,000 or $300,000 or $400,000, and when I assumed that every dollar of that gain was permanently and legally mine? Today, we are answering that question with a precision that the mainstream financial press has consistently failed to deliver. Because the Canada Revenue Agency has been quietly building an audit program targeting real estate transactions from exactly those peak years. The 3-year normal reassessment window for 2022 tax returns closes in the spring of 2026. The CRA knows this. Its audit teams know this. The reassessment notices are going out right now, and they are going to thousands of Canadians who believe their transactions were ancient history. To understand the scale and the timing of what is happening in 2026, you have to understand what the CRA's own published audit data reveals about its enforcement activity in the real estate sector. The agency is not operating secretly. It publishes its compliance results, and those results tell a story of escalating enforcement that most Canadians have never read. Between April 2024 and March 2025, the CRA applied 853 gross negligence penalties on real estate transactions totaling approximately $103 million in penalties alone, separate from the taxes owed. That is a 23% increase over the previous year's 722 penalties totaling $66.4 million. In the same 2024 to 2025 period, the CRA's Assisted Compliance Program contacted 4,513 taxpayers directly about real estate tax issues, resulting in $9 million in additional taxable income identified. These are not the numbers of an agency that is occasionally glancing at real estate files. These are the numbers of an agency running a systematic, data-driven, and accelerating enforcement campaign targeting the peak years of the Canadian housing boom. Let us build the profile of the person receiving the envelope. Let us call him Daniel. Daniel is a 47-year-old project manager living in Barrie, Ontario. In 2019, he purchased a semi-detached home in the east end of Hamilton in the Stony Creek area for $580,000. He and his family lived there for 2 years. In 2021, his employer transitioned to a permanent remote work arrangement. Daniel and his wife began spending the majority of their time at his wife's family property north of Aurelia, returning to the Hamilton house periodically. In November 2022, at the absolute peak of the Hamilton market, Daniel sold the Stony Creek property for $960,000. The capital gain was $380,000. His accountant designated the property as Daniel's principal residence for all years of ownership, claimed the full exemption under the principal residence exemption formula in Section 42(b) of the Income Tax Act, and reported zero tax owing on the transaction. The original notice of assessment for 2022 appeared to accept the return as filed. Daniel took the proceeds, added his savings, and purchased a home in Barrie for $820,000. The Hamilton sale was behind him, or so he believed. In March 2026, the second envelope arrived. A CRA compliance officer assigned to real estate transactions in the Hamilton Census metropolitan area had reviewed Daniel's file as part of a systematic audit of high-value principal residence exemption claims from the 2021 and 2022 tax years. The officer had cross-referenced Daniel's principal residence designation with electronic banking records and credit card transaction location data for those years. The data showed that the overwhelming majority of Daniel's credit card transactions during 2021 and 2022 were processed at merchants in Simcoe County and the Aurelia area, not Hamilton. The officer had reviewed Daniel's employer records showing his payroll address updated to a rural Ontario postal code in early 2021. The officer had reviewed publicly available social media content showing Daniel and his family at the Aurelia area property during extended periods in both years. The officer had found no evidence of school enrollment, medical appointments, grocery store transactions, or regular commercial activity in the Hamilton area consistent with ordinary habitation of the Stony Creek property during those years. Here is the critical detail that most taxpayers miss entirely when they receive these reassessment notices. The CRA's compliance officer did not pick up a phone and call Daniel's neighbors. The officer did not drive to Stony Creek and knock on doors. Every piece of evidence used to build the reassessment case against Daniel was drawn from existing databases and third-party records that the CRA already had access to before it opened the file. The credit card transaction geography came from financial intelligence reporting. The employer payroll address came from T4 slip data filed by Daniel's employer years earlier. The social media content was publicly visible and required no warrant or special access to retrieve. The school enrollment records came from provincial education data sharing. This is the infrastructure of modern tax enforcement. It does not announce itself. It does not ask permission. It assembles a picture of where you actually lived from the digital trail you left without knowing you were leaving it. The CRA's position in the reassessment is that Daniel did not ordinarily inhabit the Hamilton property within the meaning of Section 54 of the Income Tax Act during the 2021 and 2022 tax years. The principal residence exemption formula is reduced by 2 years. The proportional capital gain attributable to those 2 disqualified years is $162,000. The federal and Ontario provincial tax on that amount at Daniel's marginal rate is approximately $86,000. The gross negligence penalty under Section 163(2) of the Income Tax Act, assessed on the basis that Daniel's accountant ought to have known the designation was incorrect given the available evidence, adds a further $43,000. Compound interest accrued daily from the May 2023 original assessment date to March 2026 adds $11,000. Daniel's total liability from a house he sold more than 3 years ago, a house he no longer owns, a transaction he considered permanently closed, is $140,000. The CRA has registered a lien against his Barrie home to secure the debt. The legal framework enabling this reassessment is something every Canadian who sold a home in 2021 or 2022 needs to understand with complete clarity right now. Under Section 152(3.1) of the Income Tax Act, the CRA has what the legislation calls the normal reassessment period. For individual taxpayers, this period is 3 years from the date of the original notice of assessment, not 3 years from the filing date. 3 years from the date printed on the original assessment document. If your 2022 return was filed in April 2023 and your original notice of assessment was dated May 10th, 2023, the CRA has until May 10th, 2026 to issue a notice of reassessment. That deadline has not passed for hundreds of thousands of Canadians whose 2022 returns are still inside that window right now. The audit teams working on real estate files know this deadline better than the taxpayers whose files they are reviewing. The reassessment notices going out right now are the agency using the final weeks of its normal reassessment period to close cases. It has been building since 2023, but the 3-year window is not the only tool the CRA possesses. In Section 152(4) of the Income Tax Act allows the CRA to reassess beyond the normal 3-year period when it can demonstrate misrepresentation attributable to neglect, carelessness, or willful default. In practical terms, this means that if the CRA can show you knew or reasonably should have known your principal residence designation was incorrect, the reassessment period extends indefinitely. There is no expiry date. A taxpayer who designated a property as their principal residence while genuinely living there and whose circumstances changed in ways they honestly misunderstood is in a fundamentally different legal position from a taxpayer who designated a property they demonstrably never inhabited. The agency draws this distinction carefully. Its auditors are trained to identify the evidence that separates honest error from careless or intentional misrepresentation. There is a further and separate trap that has caught thousands of Canadians who sold homes in those years, and that creates its own distinct and unlimited reassessment exposure. Under Section 152(4)(b.3) of the Income Tax Act, the CRA can reassess a taxpayer outside of the normal 3-year period if the taxpayer failed to report a disposition. Prior to 2016, Canadians were not required to report the sale of a principal residence on their tax return if the full exemption applied. That requirement changed beginning with the 2016 tax year. Every sale of a residential property must now be reported on Schedule 3. Form T2091 must be filed to formally designate the property as a principal residence. That many Canadians who sold homes in 2021 and 2022 used general tax software, relied on informal advice, or worked with preparers who missed these requirements. If you are one of those people, the normal reassessment period does not apply to you at all. There is no 3-year clock running in your favor. The CRA's right to reassess that transaction does not expire. It can issue a notice of reassessment in 2028, in 2030, or in 2035. The interest accruing from the date of the original unfiled return compounds daily with no cap on the total amount that can eventually be assessed. Now let us examine the specific data sources the CRA is using to select and build these reassessment cases. The agency does not select files randomly. It uses what it publicly describes as advanced risk assessment tools, analytics, leads, and third-party data. In the real estate context, those third-party data sources include provincial land registry records showing the ownership history of every property in Canada. They include municipal assessment rolls updated annually with occupancy and use classifications. They include data from the Canada Post address change system, which records when a taxpayer changes their mailing address and flags discrepancies with the address on their tax return. They include financial intelligence reports from FINTRAC, which receives mandatory reports from real estate brokers, lawyers, and financial institutions on all significant real estate transactions. They include credit card transaction records and banking data available through third-party data sharing agreements that allow the agency to reconstruct where a taxpayer was actually spending money during the years in question. And they include geolocation data from mobile carrier records and digital platform activity that can establish with considerable precision where a person was physically present during the period they claim to be ordinarily inhabiting a specific address. What this means practically is that the CRA does not need a whistleblower or a suspicious mortgage application to identify a potentially incorrect principal residence designation. It has automated systems running continuously against its existing data holdings that flag transactions transactions where the available third-party data is inconsistent with the claimed exemption. Daniel's case was not selected because a neighbor called a tip line. It was selected because an algorithm identified that his credit card transaction geography, his employer payroll address, and his publicly available social media activity were collectively inconsistent with his claimed place of ordinary habitation for 2021 and 2022. The system found him before he knew he was being looked for. For Canadians who sold homes in 2021 or 2022 and are watching this right now, here is what you need to do immediately and in this specific order. First, locate your 2021 and 2022 tax returns and confirm that Schedule 3 was completed and that Form T2091 was filed for any property sale in those years. If either was missing, do not wait for a CRA letter. Contact a tax lawyer or accountant specializing in voluntary disclosure applications immediately. The CRA's Voluntary Disclosures Program allows taxpayers who come forward before a formal audit is open to correct unfiled or incorrectly filed returns with significant penalty relief, and in many cases complete waiver of gross negligence penalties. The moment a formal audit or reassessment is issued, the voluntary disclosure window closes permanently. Second, if you have already received a notice of reassessment for a home sale from those years, you have 90 days from the date printed on the notice to file a formal notice of objection with the CRA. This is not a negotiation. It is a legal proceeding with a hard statutory deadline. If you do not file the notice of objection within 90 days, the reassessment becomes final and legally binding regardless of its accuracy. You lose the right to dispute it in tax court. The 90-day window is not extendable by agreement or by assumption. Third, if you have received an information request or compliance review letter rather than a formal reassessment, do not treat it as routine correspondence. An information request at this stage means your file has been flagged and an officer is building a case. Responding incompletely or ignoring the request entirely accelerates the file to formal reassessment status and forfeits any opportunity for pre-assessment resolution. The cases where taxpayers cooperated fully and provided complete documentation at the information request stage resolved at significantly lower assessed amounts than cases that proceeded to formal reassessment without taxpayer cooperation. For the Canadians watching this who sold their homes honestly, who lived in them continuously, who filed their T2091 on time and reported the transaction correctly on Schedule 3, here is the specific and honest truth about your position. The principal residence exemption is not being dismantled. Genuine homeowners with legitimate designation histories and documented evidence of ordinary habitation are not the targets of this audit program. The CRA's own guidance is explicit that its risk-based selection model focuses on transactions where the available data is inconsistent with the claim designation. If your sale was clean, your filing was complete, and your habitation of the property was genuine and continuous, the 3-year window closing in 2026 is a deadline that works in your favor. Once it passes without a reassessment notice, that chapter is genuinely closed. For the people in this audience who were priced out of the housing market during those peak years, who watched neighbors and colleagues walk away from transactions with hundreds of thousands of dollars in gains they claimed were tax-free while you were told you could not afford to participate in the market at all, this is the accounting that was always going to arrive. The CRA spent 3 years building the cases. The enforcement phase is here now. The reassessment notices are being delivered. The system moved more slowly than it should have, but it has arrived and it is working through the files with a precision that the boom years made possible. In our next investigation, we are going to expose a trap that is waiting specifically for the hundreds of thousands of Canadians who renovated their homes between 2020 and 2023 using cash payments to contractors. If you spent $50,000 or $80,000 or $100,000 on a kitchen renovation, a basement finishing, or a major structural improvement, and you do not have invoices for every dollar of that work, the CRA has a specific mechanism called the Adjusted Cost-Based Audit that can deny your renovation costs entirely, inflate your taxable capital gain, and send you a bill for money. you spent years ago on improvements to a home you may have already sold. The number of Canadians exposed to this specific category of reassessment is larger than most financial advisors currently understand, and the CRA's enforcement activity in this area is accelerating heading into the second half of 2026. Subscribe to Canada Property Watch right now and make sure your notifications are enabled, because that investigation will change how you think about every receipt from every contractor you have ever paid in cash. The envelope they send you about your renovation will feel exactly like the envelope Daniel received about his Hamilton house. The only difference is whether you are prepared for it when it arrives, or whether it finds you the same way it found him before your alarm goes off on a Thursday morning, when you were not expecting anything at all.